So, what actually happens when major financial forces collide? And look, we aren't just talking about a grumpy day on the stock market here. We are talking about massive, deep-rooted global economic pillars literally crashing into one another all at exactly the same time. The reason global policymakers are sweating right now, it all comes down to one number: 50. Analysts are pretty convinced that a truly historic financial pattern is forming right under our noses in the global economy. This is a super rare setup. It's an alignment of forces we've only seen a handful of times over the last century. Basically, this specific convergence of economic conditions pops up roughly once every 50 years. And looking at the data today, yeah, it's happening again. Welcome to The Explainer. We've got something absolutely fascinating on the docket today. We're breaking down what experts are calling the half-century convergence, a rare global financial alignment. Now, my goal here is simple. Take this incredibly intimidating global economic setup, strip away all that noise, and show you exactly what is happening behind the scenes of the global economy. Here's our roadmap for today. First, the 50-year pattern returns. Then, when four forces collide. Number 3, the end of cheap money. 4, the currency chain reaction. 5, why today is different. And finally, the signals to watch. All right, let's dive right into Section 1, the 50-year pattern returns, a truly historic financial setup. You know, there are these very specific moments in financial history where unusual forces just line up and completely rewrite the rules of the game. When this 50-year environment appears, think back to the crazy 1970s, right, with the inflation crisis and the end of the Bretton Woods system, it literally has the power to dramatically reshape our fundamental pillars. It radically alters currencies, interest rates, government debt, stock markets, and the entire global flow of money. It's basically a total recalibration of how wealth moves around the planet. Moving right along to Section 2, when four forces collide. Let's look at the anatomy of this event. So, historically, these major turning points, they don't just happen out of nowhere. They emerge when four very specific forces crash into each other. We're talking about unusually high government debt, changing interest rates, intense currency pressure, and a major shift in central bank policy. Now, any one of these happening on its own is a pretty big deal, but when all four collide at the exact same time, that's when sweeping change follows. This whole thing is actually captured perfectly in this quote from the research. The setup isn't about one single event. It's about multiple forces moving together. And they hit the nail on the head, right? That is exactly what makes this so highly unusual. It's that simultaneous combination and movement of debt, rates, currencies, and banking policy that creates a literal perfect storm. Which brings us right to Section 3, the end of cheap money, driven by changing interest rates. For years, let's be honest, markets were completely accustomed to really cheap money. But as that era comes to a close, it triggers a massive domino effect. Let's walk through this chain reaction. Step 1. Interest rates rise. Naturally, this instantly triggers Step 2. Borrowing costs absolutely spike. For both governments and corporations, they suddenly have to pay significantly more just to service their existing debt and keep the lights on. Which, of course, leads to Step 3. The money moves. Investors realize the landscape has totally shifted, and that creates enormous pressure as capital rapidly migrates over to assets offering better returns in this new environment. And that flows perfectly into Section 4, the currency chain reaction and its global ripples. When borrowing costs shoot up and investors lose confidence in an economic direction, a nation's currency can come under severe pressure. And listen, these effects absolutely do not stay politely inside one country's borders. This currency pressure influences global trade, making exports and imports wildly unpredictable. It directly impacts inflation, commodities, bond markets, and worldwide investment flows. We are talking about a massive ripple effect touching literally every single corner of our interconnected economy. Okay, we are now at a crucial pivot point in our explainer. Section 5. Why today is different. This is history versus modern reality. Because look, history provides clues, for sure, but it never repeats perfectly. The world 50 years ago is a stark contrast to today. Nowadays, technology operates in milliseconds, and global trade is vastly more integrated. Central banks have completely different tools at their disposal too. But honestly, the most shocking difference is the sheer size of modern government debt. Just to put that into perspective for you, in the 1970s, the U.S. national debt was just a fraction of $1 trillion. Today, it's skyrocketing past $34 trillion. So the stage might be the same, but the stakes have scaled up enormously. Still, history is our best guide here, and it tells us that when these specific conditions align, markets experience periods of extreme volatility before they eventually find a new balance. It's going to be a bumpy ride, no doubt about it. This collision basically shakes the whole system violently until it recalibrates and finally settles into a new normal. So how do we actually navigate this? Well, that brings us to our final section, Section 6, the signals to watch. Think of this as your economic compass. You really can't afford to just get bogged down in the daily headlines right now. You need a clear checklist for the future. You've got to keep your eyes on interest rates and that mounting government debt we just talked about, watch currency movements and inflation trends, monitor central bank policy, and crucially, maybe most crucially, track where global capital is actually flowing. By watching these specific metrics, you're watching the actual tectonic plates of the economy shift, rather than just waiting around and reacting to the earthquakes on the surface. Because if this rare setup is truly developing like the data suggests, we all need to broaden our horizons. The biggest story isn't what happens tomorrow. The real story is what happens over the next several years as these massive forces slowly intertwine and completely reshape the landscape. Remember, this is a marathon, not a sprint. And that is exactly why major investors around the entire world are paying such incredibly close attention right now. So we've seen that a once-in-a-generation financial pattern really may be appearing again. We know the forces, we know the triggers, and we know exactly what to watch. The question isn't whether history will repeat exactly. We already know for a fact that it won't. So I want to leave you with this final, provocative thought to ponder as we wrap up. What happens when the same forces return in a completely different world? Keep your eyes on the signals, keep learning, and thank you so much